Hello, folks. This is Brandon Chapman with TheoTrade with you on September 8th, 2025. And what's about to happen in the market? I mean, is the CPI that comes out this Thursday, is it about to derail the two biggest bullish trades in the market currently? Now, when I say two biggest bullish trades, what are you thinking about? Are you thinking about Broadcom today, AVGO? Are you thinking about NVIDIA, for example, which was about 1.3% higher? Or are you thinking about gold? I mean, gold, once again, outperforming every sector in the market for today. On the week, gold has outperformed as well. Communications, cyclicals, no, it's been gold for the last week. What about the last 12 weeks? Well, now we're starting to bring in a little bit of past activity. And over the last 12 weeks, we have technology that's about 1.5% better than gold. Then we got communications and cyclicals there. But what we're seeing is gold is fast catching up with the broader market. Now, of course, we have the Fed announcement coming up here soon. But today, or this week rather, it is CPI is going to really come to the forefront. CPI is on Thursday, PPI is on Wednesday. PPI is what's in the pipeline. CPI is what comes out at the end of the pipe and is what consumers are paying. And that's going to be the most closely watched measure by the Fed. Now, their preferred measure is PCE, but personal consumption expenditures, but CPI comes out ahead of it. Now, what does this mean for gold? Well, why has gold been taking off over the last little week? Well, the Fed, since Jackson Hole, has really signaled rate cuts, right? The jobs number last week also just confirmed the fact that the jobs market is slowing. And that's what Powell said. Hey, the jobs market is not gaining as much traction, right? The idea if we have to have our dual mandate of inflation and employment, well, employment now is raising, and we got to start to look at that. Well, the CPI expectation for last month is 0.3%. If you annualize that, that's higher than the Fed's target of 2%, right? The annualized number year over year is supposed to come in at 2.9%. So clearly the Fed is willing to accept above trend inflation. They've been willing to do that now since 2020. We've consistently, implicitly raised their inflation benchmark to 3% instead of 2%. But now we have the concerns over jobs, and Friday's jobs number certainly is creating more cloud around that possibility that the economy may be actually slowing. By the time the jobs market starts to turn negative, you're already in recession. Jobs are lagging, at least we're talking about the monthly jobs numbers. And obviously, Powell probably had that information when he talked about, Powell talked about potentially balancing out the policy, considering employment, recognizing some of the weakness there. Now, let's circle this back. What does that mean for gold? Why is gold going up here? Because the dollar is going down, not just in relative terms, but in real terms. You can look at the dollar against the euro, for example. The last 2 days have been very, very strong for the euro against the dollar. So we're seeing that weakness there. If we look at dollar sign DXY, well, this has a 57% weighting to the euro. So it looks almost like the inverse here. If we look at the Great British Pound versus the dollar, right? You could go down the list. The dollar's weakening pretty broadly. It's actually weakening a lot against the Chinese yuan. No wonder that Chinese stocks have fared pretty well as their currency is significantly outperforming the dollar. That's going to help foreign markets outperform our markets just because that currency exchange rate. Now, as we think about gold, the dollar going down, what would cause the dollar's trajectory to turn positive? Well, right now we're pricing in Fed rate cuts. What if all of a sudden the inflation number came out significantly hotter than expectations, and now the Fed has to consider inflation even more? Maybe at the expense of jobs. And maybe as it doesn't change their next meeting in terms of rate cuts, maybe it really starts to cloud the future in terms of where interest rates will be. Because frankly, right now you have this kind of U-shaped curve of short-term rates being high. You get towards medium rate bills and notes, and the yields start to decline. And you get out here towards 30 years, it starts to pick back up again. And so the idea is that we're expecting rate cuts will probably really cause short-term yields to really drop significantly. The only question, what happens to long-term rates, for example, like the TNX CGI. This is your 10-year treasury yield. Yields breaking out to the downside. We're currently around 4%, 4.05%. If we bring up TYX, this is your 30-year Treasury bonds. 30 years now at about 4.7%. As yields go down, prices are going up. If we focus on 5-year FVX, you'll see we're at 3.5%. And if we go to 13-week, so we get kind of the full picture here. Where's the 13-week? Oh, come on. IRX, 13 weeks at 3.9%. So we're seeing 13-week dipping to 5-year, coming up to 10, and then 30 years higher. We get this kind of U-shaped curve, which is really unusual. It's inverted in parts of it. But right now we are expecting what? The bond market, look at TLT, these are price of bonds, breaking out over the last couple of days here. All in expectation the Fed is going to cut rates and we're teetering towards recession. And that maybe inflation's not much of a concern. So as we approach Thursday, we're going to get the PPI number on Wednesday, CPI on Thursday. If we start to see inflation come in hotter than expected, it may create an environment where we see some selling, maybe a retest down here of 88, maybe a pullback towards 87.50, or maybe a much bigger sell-off is coming around the corner if the Fed's not cutting rates. But again, we're in this balance period where we're balancing recession and inflation that may just create a near-term pullback. And the activity that we're seeing today, this gives us kind of a target and a time frame here. I'm going to bring up the console for you today, and we're going to type in TLT. The trade today in TLT, they're buying the 88s. This went up to 14,000 contracts. If I were to kind of erase some of the settings in here and we looked at TLT just straight, bonds, we're seeing that we'll do it the ask and above. What you're seeing is a lot of trades occurring today, buying puts, right? A lot of them at various strike prices here. A little bit kind of trickling here, not much above the open interest. We are seeing here 17,000 contracts, the September 1988s, December 12th, the 88s. The volume is significantly greater than the open interest here, especially for this week's expiration at the 88 strike. So when you think about 88 as a target here, we could readily see a near-term pullback towards 88 as we approach the CPI, and maybe a very significant print on the CPI may even drive us down further, or maybe get scared on Wednesday from the PPI number. So risk right now is to the downside in TLT. Well, what about gold? So again, dollar strengthens, gold stocks. The reality is the effect on the market broadly with the strengthening dollar should drive down S&P prices as well. But GDX has perched way up here, right? As gold has performed significantly well over the course of the last 2 weeks. Now, by the way, this all began back here with a significant print on the 19th of October, by the way, about 80,000. It was about the 20th of October, by the way, or of August, by the way, 21st in this area, which really kicked this trade off, 80,000 contracts traded. But my point is just saying is that gold has been on a tear. Gold stocks have performed well as a result of the market kind of hanging in there. But in the near term here, we could see a push to 65 or 60. And again, we key off the options market. In the options market today in GDX, let's bring it up here. This is part of a spread, for example, 5,500 contracts here. So I'm just going to clear that out. We'll type in GDX. We can see that the spread that's put on. They bought the 63s and sold the 60s. How do I know? That filled at the ask. That filled at the bid, right? 5,500 contracts bought of the 63, about 5,500 of the 60s as well. Looking for downside activity. There's some other puts being bought in here. Those calls being bought. But again, volume is exactly equal to open interest. They might have just been closed, right? So the idea is that this is the significant trade for today, and it's bearish. And again, going back to what's happening on the price here, a 63.60 is basically right here. That would not be an extraordinary pullback in gold to see. We take the last short-term swing here. Basically 60 gives you about a 61% retracement of the bullish move here. So again, buying the 63, selling the 60 seems like a really reasonable trade. You could even go a little higher if you wanted. But the point is, the risk right now in gold and bonds is not really to the upside. The risk is to the downside. We're pricing in a weaker dollar, pricing in rate cuts. We're pricing all this stuff that helps those markets. And the fact that bonds have performed well has helped gold as well. But the risk right now is that the CPI print, which is already expected to be high at 0.3% for the core, that it actually comes in higher than that and we see more selling. So for this week, at least, the upside potential in gold and gold stocks, and for bonds, long-term bonds like TLT, the upside opportunity is probably relatively small against the downside risks because we don't know what's going to happen. We're just trying to make an assessment. Which direction is it more vulnerable to seeing a bigger move? And right now, the bigger move is likely to the downside in gold and bonds. And to be honest, if those two sell off because we're maybe pulling back on interest rate cut expectations, this may help create a weaker stock market as well. Because look, I mean, dollar is weakening 1% against gold, and the S&P is essentially flat right now with about 25 minutes to go. So clearly, there's not much internal strength. A lot of the strength we perceive is a result of dollar weakness. And frankly, you look at the MAG 7-day, MAGS as the ETF that tracks it, it's up 0.2%. But really, if we kind of break things down, again, NVIDIA today, it's up 1.5%. You look at AVGO. I mean, the breadth of this rally is really, really poor. In fact, go to the Analyze tab here. Market Watch tab. Visualize, we'll change that to Index Watch. And let's focus on the S&P 100. How much breadth is there in today's move, which is flat? You'll see 39 advancing issues, 63 declining issues, and more capital, which basically says the biggest stocks out there are the ones that are making the move, and they're in technology, right? Is that going to last if the dollar starts to strengthen here? Probably not. But again, the low-hanging fruit is you could readily see a pullback in gold and bonds and a rally in stocks. But again, if that inflation print comes in hotter than expected, it could weigh on the market generally. But again, given the perch that right now gold and bonds are sitting on, the short-term risks are to the downside, or at least outweigh the upside opportunity. Maybe worth a shot to take some profits in those if you're long them, or maybe even take a bearish spread trade on those products just to kind of capitalize on any sort of downside drift that may occur here in the next couple of weeks. Well, folks, that's our video for today. We'll catch you back next Monday. You have a great one. Thank you.